Hello and welcome to Edison TV. Today I'm speaking to Greg Smith, Chief Executive Officer at IP Group, the UK-based international investor in science-based businesses across clean tech, deep tech and healthcare. Greg, many thanks for coming in again.
Good to see you.
And can we start by exploring, our analyst has recently put out a note, and he believes that IP Group offers an asymmetric risk-reward profile, skewed towards a reward, based on your exposure to the Metsera, the potential income streams from Metsera's obesity-fighting drugs. Can you discuss that?
Yeah, so I think it's probably worth just stepping back a moment to think about where this sort of came from, the origins of it. So this is IP that was developed originally, amazingly, in the 1980s. So a very well-known professor in the anti-obesity and diabetes space, Professor Sir Steve Bloom, who operates at the Imperial College and has done for many years. He carried out some original research back in the 1980s, so going back, the best part of 40-odd years. And that's not atypical for the journey that some of the science that we end up commercializing goes on. Now, of course, we weren't involved for 40 years. IP Group got involved in the early 2010s, and we helped to really sort of work alongside the scientists and the research team to build out an IP portfolio which was commercializable, that was robust, that could go into the clinic. And that all happened in the sort of the mid-2010s against a backdrop where, to be honest, the obesity space didn't have the same level of engagement from investors as it does today. So we carried on working pretty, quite relatively small amounts of capital, relatively small numbers of people, but we ended up spinning the IP into a company effectively in 2019, and that then went through a bit of development, a little bit of external capital, and eventually was acquired by a US business, Metsera, the business you referred to, and then that in turn listed in the US last year in January. And then it only survived really sort of 8 months or so. And it was, you might remember, it was subject to this very competitive bidding process between Novo and Pfizer. And so what that means now for IP Group shareholders and the economics that IP Group shareholders have is that we now have quite this point you made about asymmetry of risk. We now have effectively no development costs to bear. And the programs, the compounds that are now effectively the backbone of Pfizer's entire anti-obesity program are being developed by one of the best resourced pharma companies in the whole world. So, and Albert Bourla, who's the chief exec, made some very expansive comments about the potential opportunity of this compound and this sort of class of compounds at JP Morgan earlier this year. And so, over the course of what is quite a long-dated IP portfolio, we have potential milestones running out into the 2030s, and actually a patent portfolio which runs into the early 2040s, based around milestones and effectively royalty on net sales. So it could be very interesting, subject to, of course, the usual risks around clinical development. But if things play through, then it could be worth materially more than the numbers that we have on our balance sheet. So it's very interesting, and I think does offer, exactly as your analyst has described, quite an asymmetric risk profile in hopefully the right direction.
And you talked about the value on your balance sheet. You've recently taken the decision to attribute a discounted value for that drug on your balance sheet. Can you discuss that? How is that accounted for in your NAV?
Yeah. So again, stepping back to put it in context, you probably remember the last time we spoke and the time before that, I said that our number one priority financially for this year was to get positive momentum back into the NAV per share. And so I'm very pleased that in the full year results, we were able to report a 13% increase in the NAV per share up to £1.10. So that's, to be honest, that was the biggest focus for us in the year, was to get that momentum back in the NAV per share. Now, of course, a major component of that was the value that came about from recognizing these future licensing streams. The approach that we've taken is typical IP Group. It's much like how we would value any of our other therapeutic exposures. And what we've done is we've taken the analyst forecasts that were available at the time. So Metsera was well covered, Pfizer similarly well covered, and we've taken the sort of the mid range of that. We've discounted it back, and we've applied market-based discounts. So we think that represents a fair value for what we know today about the compounds. If the drug is anything like as successful as Pfizer are talking about, we could be materially understating it. So there's clearly potential upside in it. That said, if the compounds don't progress through their clinical trials, then we could be materially overstating it. But I think from a shareholder exposure point of view, the fact that we've got these very long-term license streams offers a very interesting risk reward. And of course, some of our shareholders have also said, well, there are royalty pharma companies out there that would enable you to monetize this sooner. We're not in a particular rush to do that, but I've always said, and our investment team would always say, everything is available for sale at the right price and at the right time. So that's something obviously that is another potential thing for us to consider. But overall, a great result, years and years of great British science that's been developed, and hopefully now in a place that can really benefit from sort of a global engine that's going to get this to hopefully help the lives of millions of people around the world. So hopefully an all-round success.
And sort of independently of the Metsera IP, you've recently reiterated your guidance of reaching £250 million in exits between 25 and 27. You recently fully exited Hinge Health. You've also realised a few other of your life sciences portfolios, and sold Monolith and CoreWeave. Can you discuss that, but also discuss how you're seeing appetite for your investments from the broader community at the moment?
Yeah, so we, again, this time last year, I'd set out an ambition or a target around being able to deliver 250 million of cash realizations from the portfolio between beginning of 25 and end of 2027. So we made good progress against that. In 2025, we realized 68 million of cash. The major component of it actually was the transaction that you mentioned. So we had a successful IPO, and that for a while. Hinge Health listed on the New York Stock Exchange back in May. We sold down as much as we could at the point of IPO. It was reasonably restricted to a proportion of each investor's holding at the point of IPO. But good news, the shares traded up from their $32 a share price up into the 40s and 50s. When our 6-month lock came off, we realized about half of the holding during the course of 2025. So that was 19 million. And then in the first few months of 2026, we realized the balance, which again was about sort of 17 million or so. So 2026 is off to a good start already. You also mentioned the CoreWeave acquisition of Monolith. So Monolith was an applied AI business. And I think to your point on, what are we seeing that's interesting in the portfolio? There's been a common theme in the last sort of couple of years of businesses that apply AI and to particular domains, particular expertise domains, and those have been quite attractive to corporate investors. So you remember Featurespace was acquired by Visa. That was applying AI and machine learning to cybersecurity, particularly payments, and combating fraud. And in the case of the Monolith exit, Monolith was basically looking at ways of being able to analyze the performance of individual cells within batteries, and the application that they applied that to was electric vehicles. So, sort of the intersection of some quite interesting areas. We announced that acquisition back in 25, but actually only about £3 million of the consideration fell in 2025. So the remaining 20 million or so will occur during 2026. So you can see already we're making sort of quite good progress to hopefully exceed the level of realizations that we achieved in 25 in 26. And then another indicator of interest in the portfolio, of course, is the amount of capital that the businesses raise during the year. So in 25, the portfolio as a whole raised about 900 million pounds. So that's about 20-ish% up on last year. It's more like 700 million in total last year in 2024. Two decent standout transactions. One was a healthcare business, life sciences business called Artios, raised just over 100 million in an oversubscribed round. That was led by very well-known life science VCs, RA Capital and SV Health. So good, validation of that opportunity in technology. And then Oxa, which is an Oxford-based autonomous software company, really interesting, on the cusp of hopefully some major commercial deals over the course of this year. I'm very pleased to see that one supported by the National Wealth Fund. So, UK investment, backing, really sort of globally leading UK science, but also alongside N Ventures, who are NVIDIA's venture capital arm. So a couple of outstanding transactions.
Interesting. And you recently announced a collaboration with Aberdeen. Can you talk about that, but also your initiatives and the traction that you're getting in terms of attracting third-party capital?
Yeah, so you might remember last time we spoke here, it was actually the similar weather, the sun was shining, and I said at the time that I was confident that we would be able to announce another private capital mandate by the time of the full year results. So it was personally very rewarding to be able to say that we delivered on that during the full year results statement. And what we described, and we didn't give a huge amount of detail because it's a relatively young relationship, but Aberdeen are one of the UK-based significant investors at scale, and some of the clients that they have are underlying workplace pension schemes. And as you probably know, under the Mansion House Compact and Accord, there has been an increasing level of interest in trying to find ways for those types of long-term investors to get access to a portfolio of companies that are in the sort of the growth, particularly the sort of the growth stage of venture. And that's exactly what we're planning to do for Aberdeen. And hopefully that mandate will be up and investing, making its first investments this year. Shortly after the results, we also, and I guess this is sort of building on the back of the 7 years of experience we've had managing Host Plus's capital in Australia, we announced a mandate for, or in partnership with Australia's CEFC. And that is a bit, you can think of the CEFC a little bit like the Australia's Green Bank, and their mandate is to try and leverage capital into clean tech opportunities, clean energy opportunities in Australia. And so we will be, we've announced effectively the first close of that fund, and the intention will be to raise a little bit more capital and then put that to work in Australia. So we've got a new UK mandate, which will have a more of a UK focus. We've got our Host Plus mandate, which is international and including Australia. And then we've got the CEFC mandate. And hopefully that's sort of just starting to demonstrate increasing confidence in IP Group as an institutional manager of these venture relationships, because I think there's a lot more that we could do, and there's a lot more capital we could put to work. So it's good progress so far.
And you mentioned artificial intelligence earlier, and your portfolio has always been characterized by its diversity and being probably less software oriented than many peers, and particular, you've got companies deploying AI in elements like healthcare, and companies sort of exposed to networking, high speed networking, that the investment cycle is driving demand for those products. Can you discuss in a little bit more detail how you see your exposure to artificial intelligence and how that's going to impact your portfolio?
Yeah, so it's definitely interesting, isn't it? I mean, I don't think any company at all is immune from both the opportunity and the challenge of this sort of incredible pace of development of AI that we've seen over the last couple of years. And in recent times, there's been commentators writing on the sort of the so-called SaaSpocalypse and the fact that AI is going to completely destroy all these business models. I think there's definitely nuances to that, and there'll be areas where you've got a trusted long-term SaaS provider where their clients will probably say, well, actually, we'd prefer you integrated AI into your tools rather than us have to rip that all up and come up with some new suppliers, sort of thing. So I think there's definitely nuances to that. From an IP Group point of view, generally speaking, our businesses are either enabled by or are enabling this AI transition. We have very limited exposure. I struggle to think of much at all to SaaS-based pure sort of AI business platform level businesses, and we certainly don't invest in the models because they're sort of too energy and capital intensive. We can't compete with the tens of billions that's been deployed there. I mean, we might do one or two things, watch this space, but nothing that's going to require that level of capital. So I think the interesting point from our shareholders' point of view is, generally speaking, our companies are enabled by this opportunity rather than threatened by that. To try and put some examples around it, today is World Quantum Day. We're April 14th. No idea why it's April the 14th, but World Quantum Day. So that's an area that the UK has got particular expertise in. The UK government has been talking a lot about allocating additional capital and resources. We've been an investor in future compute like quantum for many years. We've got some good exposure in the portfolio. Similarly, we've got things like optical computing, a great business called Lumai from Oxford, which is massively lower power consumption because you're using photons and light rather than the electronics, which require transistor switching, which is quite energy intensive. So that's really interesting. Novel forms of memory that enable quicker transition of data between the processing bit and the memory. So there's some really interesting over the next, I think, 1 to 5 years of development of the whole core infrastructure behind AI for us to look forward to. And then, of course, we have companies that are applying AI. So you mentioned in the healthcare space. So let's double click a little bit into genomics and genetic sequencing. So the UK, another brilliant strength in DNA sequencing. Oxford Nanopore, which is one of our bigger holdings, as you know, is now a quoted company in its own right. They have been using GPUs to sort out the base calling from their raw signal for many years now. And so that, most of the significant improvements that they've seen in throughput and analysis has been brought about by this incredible increase in compute power. But then on a different side of the coin, we have a business called Genomics, and Genomics has got the world's leading database of sequence DNA information that allows corporate partners, allows healthcare providers, allows people like drug discovery companies to be able to analyze different genetic data and determine whether or not particular compounds are going to be better suited to particular disease or different populations of disease with a proper genetic underpin to it. And again, that's now being powered by agentic AI, which sits on top of the data layer. So there's lots of opportunity. So I think looking forward overall, we've got a lot of confidence in the business, and that was partly brought about because we achieved sort of 3 key objectives this year in 2025. We increased our NAV per share. We were able to realize 68 million from the portfolio, and that enabled us to use some cash to reinvest in the portfolio. But I think also worth pointing out, we actually retired about 10% of our shares in issue during the year. We had a very aggressive buyback program given the discount in our NAV per share. So that set us up very nicely, I think, for the future. We've got some great exposure to life sciences, to clean tech, to deep tech. We've got a very strong balance sheet, and now that we're starting to see some meaningful traction on the private capital side, we're looking forward with real confidence.
Greg, great to see so many things moving forward so positively, and all the things going on with the business. Many thanks for joining me again today.
Thanks for having me.